Hello clients and friends, this is Billy Doty from Grandview Financial Group, and it's my pleasure to present our year-end proactive tax planning for 2023 workshop. At our firm, we partner with clients and believe an educated client is our best client. While we will always try our best to help you, when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can help them make an informed decision. We believe that taking a proactive approach to your tax planning instead of a reactive approach could produce better results. Let's start by quickly distinguishing the difference between tax planning and tax preparation. Tax planning is looking ahead before year end, whereas tax preparation is filling out your tax forms after year end. For 2023, there are still 7 individual tax rates. They are 10%, 12, 22, 24, 32, 35, and 37%. Under current law, this 7-rate structure, which was created by the Tax Cuts and Jobs Act, is scheduled to automatically phase out January 1st of 2026. For 2023, the standard deduction amounts for those who do not itemize has slightly increased. Those amounts are $13,850 for individual filers and married couples filing separately, $27,700 for married couples filing jointly and surviving spouses, and $20,800 for heads of household. So, how should you view itemized deductions if you do not take the standard deduction? The old rule was primarily to try to accelerate or realize deductions and take them as soon as possible. With the higher standard deduction, the new rule is to time or carefully plan deductions. In 2023, long-term capital gains still receive a substantial federal income tax break. There are still 3 tax rates of 0%, 15%, and 20% for long-term capital gains, which are for assets and investments you have held for a year or more. As part of a year-end tax planning strategy, it can be helpful for taxpayers to review tax gains and loss harvesting. Harvesting capital losses is a strategy that has a taxpayer selling assets that are at a loss to offset capital gains. This is a tax deferral strategy that could be valuable. A key fact to remember is you can use up to $3,000, $1,500 if married filing separately, in capital loss above capital gains to offset ordinary income. Capital gains harvesting means taking capital gains and paying taxes in the current tax year. Remember, when taking a long-term gain for tax purposes, although the tax is paid at a lower rate, it is paid sooner. For those who are not fully retired yet, remember to review your year-end retirement contribution planning. Here's some 2023 contribution plan maximums that could be applicable if you are participating in one of these plans. If you have questions about retirement plans, please call us. For some people with IRAs that have not been taxed, a partial or full Roth IRA conversion could be something to consider. Some benefits from Roth IRA conversions include they could lower your overall taxable income long term. Roth IRAs enjoy tax-free compounding. Roth IRAs have no RMDs, which is currently at age 73. Roth IRAs allow tax-free withdrawals for beneficiaries. Roth IRA conversions are not for everyone, but if you would like to explore one, then please see us or your tax professional. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. As a result of the Secure Act, overall family tax bracket management is a critical area for those with untaxed retirement assets to explore each year. One of your choices is always to leave everything the way it currently is. If you're in a higher marginal tax bracket than your beneficiaries, then it might make sense to let them take distributions after your death in their tax bracket rather than you in yours. However, if your beneficiaries are in a higher marginal tax bracket, then it might make sense to take distributions in your tax bracket before death, and then to convert these accounts to Roth IRAs and leave your beneficiaries an account that still must be taken out in 10 years, but it can grow tax-free. An annual step to consider is to review your marginal tax rate and your beneficiaries' marginal tax rates each year. College savings plans can also bring tax efficiencies. If you want to explore tax-efficient ways to save for college, please give us a call. Let's talk about annual gifting now. You may gift up to $17,000 tax-free to each donee in 2023. This is a $1,000 increase from $16,000 in 2022. These annual exclusion gifts do not reduce your lifetime gift tax exemption. This annual exclusion gift is doubled to $34,000 per donee for gifts made by married couples. You can also help someone with medical or education expenses without incurring gift taxes. There are opportunities to give unlimited tax-free gifts when you pay the provider of the services directly. The medical expenses must meet the definition of deductible medical expenses. Qualified education expenses are tuition, books, fees, and related expenses, but not room and board. You can find the detailed qualifications in IRS Publications 950 and the instructions for IRS Form 709 at www.irs.gov. For those of you with larger estates, a wealth transfer planning item to think about is the exemption amounts for gift, estate, and generation skipping taxes for 2023, which is 12.92 million or 25.84 for married couples. Any amount over that is subject to 40% federal taxes. This high amount provides high net worth individuals a significant planning window to make gifts and set up irrevocable trust. As a reminder, as of now, in 2026, the estate tax exclusion will return to approximately $5.6 million, which is $6 million adjusted for inflation. On November 26, 2019, the Treasury Department and the Internal Revenue Service issued final regulations under IRS-2019-189, confirming that individuals who take advantage of the increased gift tax exclusion or portability amounts in effect from 2018 to 2025 will not be adversely impacted when this tax law sunsets on January 1st, 2026. If you have a large estate, this is something to discuss, so please call us. Qualified charitable distributions, or QCDs, are still a strategy for retirement savers. As part of the Secure Act 2.0, required minimum distributions, or RMDs, were changed to start at age 73 instead of age 72. Qualified charitable distributions, or QCDs, are a tax law provision that allows retirement savers over age 70 and a half to directly distribute up to $100,000 to eligible charities straight from their retirement accounts and not pay tax on this distribution. One idea that experts suggest is if you are charitably inclined, consider using part or all of your required minimum distribution, or RMD, for qualified charitable distribution. If you meet the qualifications to utilize this strategy, the funds must come out of your IRA by December 31st, 2023. They must also go directly to an approved charity. Like many of the other strategies we're discussing today, this is one that needs to be done properly, so please see us or your tax professional about this strategy. The Tax Cuts and Jobs Act in 2017 brought many changes to the tax code. Unless any changes are signed into law, here are a few key tax rules that are set to expire December 31st, 2025. Some changes that are already scheduled include individual income tax rates. If no action is taken before 2026, these tax rates will expire at the end of 2025. In 26, we will go back to the 2017 tax rates adjusted for inflation. The tax rates we have today are lower and much wider, meaning in many cases, more income is taxed at lower rates when compared to 2017. For planning purposes, given the same level of income, most people could find themselves paying more in taxes in 26 than in 23. Elevated estate tax exclusions. As of now, barring any changes, in 2026, the estate tax exclusion is due to revert to pre-2018 levels, adjusted for inflation, which will be approximately 6 to 7 million for individuals. This is almost half the current limits of 12.92 for individuals and 25.84 for couples. Currently, there's a 40% maximum gift and estate tax rate. This rate is set to increase in 2026 to 45%. The SALT cap will disappear. The Tax Cuts and Jobs Act eliminated or limited many of the previous laws concerning itemized deductions. An example is the state and local tax deductions, or SALT, which is currently capped at $10,000 per year, or $5,000 for taxpayers filing separately. This cap is set to dissolve after 2025. We enjoy keeping clients aware of tax law changes, so you'll be learning more about this sunset provision as we get closer to 2026. Please remember, a proactive approach to your tax planning instead of a reactive approach could produce better results. One of our goals is to keep clients updated when tax laws change so they can proactively plan. If you'd like to discuss how these sunsetting rules or any tax law changes may affect your situation, please feel free to contact us and we'd be happy to assess your unique financial situation. So, what can you expect from us? One of our main focuses is to review changes for our clients on an ongoing basis. You can expect regular communication, more frequent discussions, and you can expect that we're continually reviewing economic, tax, estate, and investment issues for our clients. In fact, we will be offering other workshops that highlight tax changes and planning ideas. We appreciate our clients. As a client benefit, you can add names to our mailing list for information. We hope you will take advantage of this and add 2 names or more to our list. One of our goals is to continue to help others. Some of our best clients will refer to us by existing clients. So please feel comfortable letting us know that names of anyone who you feel could benefit from our services or information. Again, one of our primary goals is to keep clients informed, and we appreciate you attending our session. Please call us if you have any questions. Once again, we're thankful for the opportunity to assist you with your financial needs. Remember, at our firm, clients come first, and your health and well-being is our highest priority.